So finally in 6.3 here, we have the Federal Reserve and monetary policy. If you remember back in 6.1, we talked about what happens if we're outside of our long-run equilibrium. Well, we said that sometimes the government steps in order to do something about it. In 6.2, we saw how fiscal policy, those actions of the government, can do something about being outside of our long-run equilibrium and move us back to that point. In 6.3, though, we're going to talk about actions of the Federal Reserve. The Federal Reserve is the national bank of the United States, and sometimes they can take action in order to cause shifts of the aggregate demand curve and bring us back to a long-run equilibrium. First of all, what is the Federal Reserve? Well, again, it's the central bank of the United States. Their goal is to promote stability, and a lot of times they do that by controlling the money supply, which can influence interest rates and in turn impact the price level and impact unemployment. The Federal Reserve Act of 1913 came around kind of in a response to the Panic of 1907, and it created a Federal Reserve System in order to stabilize our economy. What they could do is offer services like a bank might do for you. It kind of serves as the bank's bank. They can take deposits from banks, they can make loans to banks, they can provide a lot of those same financial services to banks. They also standardize the currency with the Federal Reserve notes. If you look at any cash that you have, across the top of it actually says Federal Reserve note. And you'll see within the seal, maybe on like a $1 bill, where that money actually originated in terms of what Federal Reserve Bank it originated from. And it also just strengthened our banking system as a whole, which was a goal of it when it was created about 105 years ago. So as we talk through this, we want to introduce what is going on in our Federal Reserve System. What do we have set up? What does it look like? What's the structure? Well, first of all, at the top, we have the Board of Governors. The Board of Governors is a group of 7 individuals who are appointed by the president to 14-year terms. These are non-renewable terms. Now, their 14-year term begins, and then every 2 years, another one of those 7 people at the table is reappointed. And so by the time you make it all the way back around the table back to you, you're at the end of your 14-year term. And so, again, these 7 members appointed by the president to 14-year non-renewable terms in order to supervise and regulate the Federal Reserve. We then have the district banks of the Federal Reserve. There's actually 12 district banks that are across the nation in cities such as St. Louis, Chicago, Philadelphia, Boston, and Atlanta. These banks exist in order to help be the bank's bank. They're coordinated by the Board of Governors, and they do those same kind of financial services that your bank does for you. They might make loans or accept deposits, just like, your Chase Bank might do for you. Kind of coming in between the Board of Governors and the 12 federal district banks, we have the FOMC. Now, it doesn't necessarily come between, but it uses members from both of those. We see that this 12-member committee is made up of those 7 members of the Board of Governors, as well as 5 bank presidents, the New York Bank president, plus 4 other of the bank presidents on a rotating basis. They meet together in order to help direct monetary policy. This is going to become a lot more important a little bit later on in this video. We then have the FAC, the Federal Advisory Committee. They serve in order to advise the Board of Governors. This is made up of 1 representative from each bank throughout the districts. And what they do is they look at the overall health of the economy and they advise the Board of Governors in terms of maybe what inflation or maybe what unemployment is looking like specifically within their district and what trends they might be seeing. Finally, below that part of the Federal Reserve System, we have commercial banks. These are like the banks that you and I might go to store our money. There's thousands of commercial banks, and a number of them are member banks. What that means is they are part of the Federal Reserve System. Whenever they become a part of the Federal Reserve System, they actually have to purchase shares of stocks in the Federal Reserve. So they actually own the Federal Reserve in a sense. We see that the Federal Reserve Bank is owned by its members. Only about 40% of banks throughout all of the United States are actually member banks because nationally chartered banks are required to become members, but state chartered banks have the option to become members if they meet certain requirements. However, again, like we said, only about 40% of all banks across the country are actually members of the Federal Reserve. Below that, then, we have households and businesses. In the same way that the federal district banks serve as the bank to commercial banks, we serve as the customers to commercial banks. So what are some jobs of the Federal Reserve? Well, obviously they issue and maintain currency. We talked about that with them having the Federal Reserve notes. We also noticed that they provide financial services like making loans or receiving deposits from commercial banks. They set the reserve ratio. Again, that's going to come up a little bit more important later. And they also act as the government's bank. The government has a large account on hand when it comes to like tax money and things like that. So we need someone to take care of it. Regulating and supervising the banking system, but finally controlling the money supply. Controlling the money supply is hands down the most important job that the Federal Reserve has. Why? Because that money supply ends up impacting interest rates, and impacting those interest rates has an impact on investment and not only investment but also consumer spending, and that has an impact on our GDP. This is actually referred to as monetary policy. That idea that these changes in the money supply can actually have an impact on interest rates, which then impact the entire economy through investment, through consumer spending, and obviously our real GDP. As we go through this, we need to make sure that we understand the relationship between the money supply and interest rates. So first of all, I want to draw this graph quickly showing our money supply, which is a vertical line. The reason it's a vertical line is because our money supply is not dependent on interest rates. It's not dependent on the price of it in order to determine how much there is. That's a kind of a stable number that's determined by the Federal Reserve. We see that the demand for money is downward sloping, obviously based on the price of money. The price of money is just an interest rate. Down along our x-axis, we have the quantity of money. Like we said, this point right here represents the interest rate. That intersection is our equilibrium price of money. The price of money, being an interest rate, is just how much the borrower must pay back in addition to the original loan. That original loan payback is known as principal. We have interest on top of that that must be paid back. Whenever interest rates are high, just like the price of anything else, the price is higher and demand for it goes down. Whenever prices are low or interest rates are low, the demand for loans increases. It's that law of demand in action. So what happens when we have monetary expansion? Monetary expansion is whenever we see an increase in the money supply. Well, whenever our money supply goes up, we see a shift to the right of that money supply curve. As you notice, we now have a new equilibrium point. That new equilibrium point is at a lower interest rate. It's at a lower price of money. Therefore, whenever that money supply goes up, banks have more money that's sitting around. In order to get rid of it, they have to lower the price of it. So interest rates drop. Whenever we see interest rates drop, people, businesses, anyone who wants to take out a loan, it's now cheaper for them to do so, and they're more willing and able in order to do that. And so individuals and businesses, they borrow money in order to invest it or to spend, and as that happens, it actually has an impact on the I and a little bit on the C of our GDP formula. Investment's going to go up, consumer spending is going to go up. That causes an increase in our GDP. So whenever the money supply increases, just know that the real GDP is also going to increase. The same thing is true whenever we have monetary contraction, or meaning that we're shrinking our money supply. Whenever we see our money supply shrink, we see a leftward shift of that money supply curve. We see that the amount of money that's in the economy actually decreases. Well, whenever that happens, if we were to stay at our previous interest rate, that 3%, we actually have a shortage. If you notice, our supply is to the left of our demand. And because of that, what we notice is that since there's less money that's available, we see that interest rates are actually driven up. Because banks have less money to loan out, the price of money, or the price of a loan, an interest rate, is going to increase. Now, as those interest rates increase, it actually decreases the willingness for individuals and businesses to take out money, to borrow it, and to invest and spend it. Because that causes our I to decrease and even our C to decrease, that causes our GDP to go down as well. So what you need to know is that as money supply decreases, GDP decreases too. So, how does the Fed interact with this money supply? Well, as you saw, whenever we have an expanding money supply, we'll have an increase in GDP due to an increased investment and an increase in spending. In the same time, whenever we have a contracting money supply or a shrinking money supply, our GDP is going to decrease due to decreased investment and decreased spending. So the Federal Reserve can actually influence this money supply. They can change the money supply in order to help our economy recover from a recession or expansion, meaning that whenever we're outside of our long-run equilibrium, the Federal Reserve can actually do some things in order to increase our aggregate demand or decrease our aggregate demand and bring us back to that long-run potential. Now, this all has to do with changing our money supply. Remember, because a change in the money supply ends up changing our interest rates, it changes our willingness to invest or spend, which changes GDP. Now, they can't directly change GDP. There's kind of this chain reaction that takes place. But the chain reaction that takes place kind of starts with the money supply. So what tools does the Federal Reserve have to influence the money supply? Well, what they can do is they can change the reserve ratio, they can change the discount rate, or they can perform something that's known as open market operations. So let's start with the reserve ratio. If you remember, the reserve ratio is that fraction of money that the banks are required to keep on hand whenever they receive deposits. So let's say the bank receives a deposit of $10,000 with a reserve requirement of 10%. Well, first of all, we want to understand, out of this deposit, how much money can be created by the bank through loaning. So we have to first know our money multiplier. Our money multiplier is 1 divided by our reserve ratio. So 1 divided by 10% means our money multiplier is equal to 10. We take that 10 and multiply it by our excess reserves. Our excess reserves is whatever's left over after we hang on to that required reserves. So 10% of 10,000 is $1,000, leaving $9,000 in excess reserves. We take the 9,000 in excess reserves, multiply it by our money multiplier of 10, and we find out that through this whole entire loaning process, $90,000 could end up being created and added to the money supply. We're going to kind of use this as a baseline and see what happens whenever we increase or decrease the reserve ratio. Let's say we decrease that reserve ratio down to 5%. We just decrease the reserve ratio. This is known as an expansionary policy because we're expanding or growing our money supply. How does that work? Well, first of all, we have to take a look at what our money multiplier would be. Again, it's 1 divided by our reserve ratio of 5%. 1 divided by 5% is 20. We then look and say, what is our excess reserves? That's what we're going to be multiplying it by. Our excess reserves is $9,500. 20 times $9,500 equals a $190,000 change to our money supply. As you notice, whenever we decrease our reserve ratio, we see a great increase in our money supply. So therefore, as you decrease the reserve ratio, the money supply is going to increase, causing monetary expansion, which ends up leading to an increase in our GDP. What happens if we took our reserve ratio the other way and increased it? Well, if we have a $10,000 deposit with a 20% reserve ratio, we find that we have a money multiplier of 1 divided by 20%, or 5. And we multiply that times our excess reserves. Our excess reserves is that remaining 80% of $10,000, which is $8,000. 5 times 8,000 equals a $40,000 change in the money supply. So as we increased our reserve ratio, we were actually implementing a contractionary policy, meaning we were shrinking or contracting the money supply. Because if you notice, by increasing the reserve ratio, our money supply would actually decrease from $90,000 down to $40,000. We also have something known as the discount rate. The discount rate is just the interest rate that the Federal Reserve is extending to its member banks in order to take out loans from the Federal Reserve. Now, banks may take out a loan from the Fed for a couple different reasons. One of those might be in order to meet their reserve requirement. Maybe they get to the end of the night and they're not at their reserve requirement for the day, and so they have to take out a loan from the Fed in order to meet that reserve requirement. Maybe they just want to make out more loans for the day, and so they borrow money from the Fed in order to do that. Now, by changing this interest rate, it can influence the willingness of banks in order to take out loans from the Fed. Let's say they decrease that discount rate. This is an expansionary policy because whenever the discount rate falls, it's now cheaper for banks to borrow money from the Federal Reserve, meaning that they're more willing to borrow, which means more loans can be made, meaning that our money supply is going to increase. Now, if they increase the discount rate, which is a contractionary policy, it becomes more expensive for banks to borrow money from the Federal Reserve. And as it becomes more expensive for to borrow money from the Federal Reserve, banks are less willing and able to take out those loans, meaning fewer loans are going to be made by the banks, decreasing our money supply. So again, decreasing the discount rate is an expansionary policy. It expands our money supply. Increasing the discount rate is contractionary. It decreases our money supply. Finally, and maybe the most important one of all these, is open market operations. What the Federal Reserve actually does is they perform these open market operations by buying and selling government bonds and government securities, which is just government debt, out on the open market. What they do is they go out to the open market and they say, hey, we would like to purchase your government debt, your government IOUs. They go to commercial banks and they do this. Now, why might commercial banks hold government bonds or government securities on their balance sheet? Well, again, it's a low risk, low reward investment. It's something that's safe. And sometimes if banks have cash that's sitting around, they'd rather that cash work for them. And so what they do is the banks might actually purchase government bonds or government securities to have on their balance sheet. Now, this buying and selling does happen between commercial banks, and it's coordinated by the FOMC. If you remember from earlier on, the FOMC is the Federal Open Market Committee. This is that committee made up of some of the bank presidents and the Board of Governors in order to determine what kind of monetary policy should take place. Now, let's say that they decide to buy government securities, meaning the Federal Reserve decides to buy government securities from commercial banks. Well, what that means is that in order to receive those government securities, the Federal Reserve must provide money to the commercial banks. And so this exchange happens where the Federal Reserve gives cash money to the commercial banks, and the commercial banks in return give government securities to the Fed. What that actually does is taking money that was never in the money supply, it was just sitting at the Federal Reserve, and putting it into the money supply. So when the Federal Reserve buys government securities, they are taking on government debt, but they are extending money into the money supply, increasing the money supply. Whenever they sell government securities, they approach commercial banks and they sell those securities, giving the IOU or giving those securities to the bank, and the bank's giving cash to the Federal Reserve. Whenever they give that cash to the Federal Reserve, this is money that was once in the money supply, but now it's out of it. It's now just sitting at the Fed. Whenever that money goes from being in the money supply at the banks to being out of the money supply at the Fed, it's decreasing the money supply. So buying government securities is an expansionary policy. It's increasing the money supply. Selling government securities is a contractionary policy. It's decreasing the money supply. So how does this all have an impact on our aggregate demand and aggregate supply curves? Well, let's say again that we're sitting here in a recession and we need expansionary policy to get us out of the recession. Whenever we're below our potential and unemployment's high in this recession, we need expansionary policies by the Federal Reserve. Well, what are the three different policies that the Federal Reserve might take? Well, one, they could decrease the reserve ratio. Remember, by decreasing the reserve ratio, it increases the money multiplier and increases the excess reserves, which multiplied together increase the money supply. They could also decrease the discount rate by bringing down that rate at which banks borrow money from the Federal Reserve. What that does is it encourages banks to borrow money and make more loans, which creates more money in our money supply. And finally, they could buy government securities. By buying up those government securities, they are taking on the government debt and they are extending money into the money supply, giving it to banks where banks can make more loans and create more money, increasing the money supply. This would cause a shift to the right of our aggregate demand curve because, as we said before, an increase in the money supply would then have an impact on our interest rates, lowering the interest rates, which would encourage investment and increase consumer spending. This would result in a fixed recessionary gap. Fixing this recessionary gap, it brings us from our YE output to our YP output at our potential. It also increases our GDP to our potential from where it was before. And also our unemployment's been lowered back down to our natural rate. Well, what happens if we're in an expansionary gap and we need contractionary policy? If we're above our potential and prices are rising too fast, we're experiencing rapid inflation. Well, what kind of actions could the Federal Reserve take? What kind of contractionary monetary policies could the Federal Reserve put into place in order to fix the economy? Well, first of all, we want to get that money supply to shrink because by getting the money supply to shrink, you're increasing interest rates. By increasing interest rates, you're discouraging investment, which shrinks the GDP. And so what we want to see is since we want to have our GDP reduced from YE to YP, we would need to do one of three things. We could increase the reserve ratio. By increasing the reserve ratio, what you're doing is making that money multiplier smaller, making excess reserves smaller, therefore making the multiplied product of them even smaller, decreasing the money supply. You could increase the discount rate. By increasing that rate at which banks borrow from the Fed, it discourages banks from taking out money from the Fed. And by discouraging that, they're actually discouraging the banks making more loans. Or the Federal Reserve could sell government securities. By selling those government securities or those government bonds to the commercial banks give the Federal Reserve cash in return. That cash was once sitting in the bank is now being pulled out of the money supply as it heads to the Federal Reserve. This would cause a shift to the left of our aggregate demand curve, bringing us back to our long-run equilibrium at our potential. Whenever that happens, we see that our expansionary gap has been fixed. Unemployment's back at its natural rate. It's back at our full employment rate at YP, at our potential. And price levels is stabilized as our price levels drop from PLE1 to PLE2. One thing I want to make sure you all understand is how fiscal policy and monetary policy go hand in hand. Really what we're seeing is just two different groups, the government and the Federal Reserve, implementing policies that are attempting to do the same thing. They just have different tools in order to get it done. So how might expansionary policy look from a fiscal standpoint or from a monetary standpoint? Well, again, we're trying to get our aggregate demand curve to increase. Getting our aggregate demand curve to increase is getting our Y to increase. And again, if we want Y to increase, what we have to do is see either the C, I, G, or X sub N increase as well. What the government might do, what they have power over, is increasing government spending, which increases the G. They could also decrease taxes. Decreasing taxes gives more disposable income to consumers, and by doing that, it increases consumer spending. The monetary policy actions that could be taken would be decreasing the reserve ratio, decreasing the discount rate, or buying government securities. Any one of those three things would end up increasing the money supply, causing interest rates to fall, encouraging investment, which causes an increase in the I of our GDP formula, causing Y to increase. Contractionary policy actions could be taken too by both the government and the Federal Reserve. The government, what they might end up doing in order to get our aggregate demand curve to shift to the left, is decreasing government spending, causing that G to go down, which would cause our Y to go down. We could also increase taxes. Increasing taxes would reduce the amount of disposable income in households, and decreasing that would end up causing a decrease in, increasing the taxes would cause a decrease in disposable income and cause a decrease in consumer spending. Monetary policies that could be taken by the Federal Reserve include increasing the reserve ratio, increasing the discount rate, or selling those government securities. So keep in mind, these 5 different kinds of policies go hand in hand. Again, they're done by different groups, but they're all attempting to try to do the same thing, and sometimes they coordinate together in order to help the health of the economy. Finally, what we want to take a look at is what happened during the Great Recession. The Great Recession, again, just happened over 10 years ago. And what the Great Recession showed us is how different policies could be put into place in order to help our economy recover. So this recession started off in December of 2007, and we saw our negative GDP growth happen until June of 2009. Our real GDP actually fell by 4.3% during that time before we started to see any sort of recovery. Unemployment ended up hitting 10% later in October, and so we were still feeling the effects of the recession even after it ended technically in June of 2009. Now, what did the government and what did the Federal Reserve do to step in and fix this problem? Well, the Federal Reserve actually took a couple different actions. One thing that they did is they dropped the discount rate from 4% in January of 2008 to 1.75% in October of 2008. Again, what this would cause is banks to want to take out more loans from the Federal Reserve and extend more loans to its consumers, its customers. By doing that, what we're able to do is increase the investment and increase the Y of our GDP. The Federal Reserve also bought trillions of dollars worth of government securities over the next 7 years. They implemented this policy known as quantitative easing, meaning they weren't only buying up short-term government bonds and securities, they were buying up long-term assets as well. Because what they wanted to do was to buy up those securities and increase the amount of money that was in the money supply. The government took action too through a legislation that was known as the American Recovery and Reinvestment Act. This was almost $800 billion worth of tax breaks and incentives and money that was spent on things like education and infrastructure. Again, they pumped over $800 billion in spending and tax breaks, meaning they were increasing spending at the same time as decreasing taxes. So the Great Recession is an example of how we saw 4 of those 5 different expansionary policy actions take place in order to help our economy recover and get back to where we wanted it to be.